Hello and welcome back to today's personal finance show here on Dublin City FM with me, Paul Merriman from askpaul.ie. I mentioned before the break we were going to have Brian Landon, who is head of mortgages from Avant, and we're going to be talking about the mortgage market. As you will probably hear from all the adverts we do, Avant are the sponsor of the show, so it is great to have them as sponsor of the show, especially considering their market impact here since starting their mortgage business in Ireland, and what they've done for consumers. Regardless of the fact that he's staring across the desk looking at me here, I've always said this, their mortgage interest rates and their long-term fixed products, and they've really brought that European bank option to Irish consumers, which I've been screaming for I think we started last fall about 8 years ago. So I do think what they've done for the Irish marketplace, especially when you look at Ulster Bank and KBC having exited as well, it's brilliant. But anyway, enough throwing bouquets at you. Brian, you're very welcome to the studio. Thanks for coming in to see me.
Thanks very much, Paul. Lovely to be here again, and great to be sponsoring your show too.
Brian, we're going to have a talk about the mortgage market, but first can we talk about the key trends that you're seeing in the Irish marketplace, especially since the last time we had you in. I think you were in about 3 or 4 months ago. Let's talk about a few things. The first thing I want to talk to you about is the reapproval. So people having to go back and look for more money because they're getting outbid. Second thing we might look at is the first home scheme exit. So people that are using Avant to maybe take the equity part away from the government and put it back into their own names, especially because house prices are increasing so quickly. And also the rise of overpayments, because I've always said the big thing for you guys is that you allow up to 10% of the balance to be overpaid, where if you look at Bank of Ireland, for argument's sake, it's only 10% of the repayments to be overpaid. So it's a massive difference and offers massive flexibility for clients. It's penalty free. So why don't we go for actually one of the most interested here probably for consumers, especially first time buyers that bought in the last number of years. Can we talk about the first home scheme and what you're seeing mortgage holders do there?
Yeah, so for really since about the start of the year, we've started to see consumers come to us having taken a mortgage and first home scheme stake in their home, probably in 2022 or 2023, and they're starting to see those mortgage rates they took initially roll over. And they're starting to think about, should I pay off the equity portion now? And we're more than happy to finance that. We're more than happy to give them a fresh mortgage. And they're also coming from a situation where they may have taken that mortgage at a rate of, the high 3%. Rates have now dropped, so there's an opportunity to get a lower mortgage rate, but also refinance the equity. And the other thing they're thinking about is that equity is appreciating in cost to them by the cost of inflation in houses, at least. So if you borrowed, a typical 450,000 home, you took 20% of that originally as a first home scheme portion. So in other words, 90,000 of value, right? Now you find yourself in a situation where that home is now worth maybe 600,000 and 20% of that is 120,000 you now owe. So those smart consumers who can afford it and who can leverage the fall in interest rates are suddenly finding themselves an opportunity to refinance very effectively.
Kind of a perfect storm, because on the one hand, their own 80% of the value in that example has gone up as well. So they obviously own a much bigger portion. And then they might find themselves in a situation where they might still have a much stronger LTV. So they went in with maybe an 85% LTV or 90% LTV. They might be down below 80 now. So yeah, it gives them a lot more opportunity. So they can get rid of the government and make sure that all the equity stays with them for the next, 20, 30, 40, 50, 60 years. It's a really good system actually, because being able to get out of the first home scheme, I think the first home scheme was brilliant when it came out first. I think the criticism it got, it didn't deserve. I don't think it's had a negative impact on prices, to be honest with you. I think the supply has done that. But yeah, the first home scheme has always been a situation where you can repay it back to the government at any stage, and the fact that you can remortgage and do it if you have the income and you have the kind of the affordability is a really, really, really good idea, because like I say, you don't want to be building the equity for the government for the very foreseeable future. So it's a really good one. Let's talk about the overpayments next, if you don't mind, and what you're seeing there.
So we're seeing, Paul, we've always had the 10% overpayment allowance, and we've always seen consumers use that. And you typically see that spike every January, presumably after bonuses are paid, and again every April after bonuses are paid. What we're seeing this year is probably double the level of overpayments than we've seen in previous years. So, you're kind of thinking, what's going on? Why are consumers suddenly deciding to overpay more of their mortgage? A couple of things. I think one is, maybe people are a little bit more nervous about the global economy, maybe thinking that pay down a little bit more debt might be a safer position. We definitely see that. But we also know there's 150 billion sitting in, and you've talked about it enough, in people's current accounts. So why not put that to use in a way? And some of those people are choosing to overpay their mortgage.
It's a great option. Again, from a financial planning point of view, there's loads of things to do with that money. I think getting a financial planning consultation, have a look at the options, whether it's ABC and pensions, whether it's looking at kids' education funds, or overpaying even higher interest debts, like whether it's car loans, credit cards, personal loans. But yeah, trying to get, a lot of people want to be mortgage free. I also think, I spoke to a client of this recently who bought a property 4 years ago. We use Avant, they were paying a little bit of the overpayment, nowhere near 10% of the capital. And what made him change his mind, or them change their mind, it was a couple, was they felt that because the market had moved so high and the value of the property value had gone so high, but they put a lot of work into the first 2 years, and they burned through all their cash. So I find a lot of people, especially if you're buying in Dublin or any kind of major city now, you need a big deposit. If you're buying second hand, you probably need to do a lot of work to the property. You want to do a lot of work to the property in the first couple of years. And now they found themselves back in a cash flow position of having decent levels of cash. I think it was like 40k. And they didn't know what to do with the money. They already had maxed out the pension funds. They'd already kind of got everything else set up. So people forget that before you buy a mortgage or buy a property and take a mortgage, you've probably saved a lot of money over a few years, and you might have really high incomes and have really good cash flow, but you forget what to do with it then. Because it just does build up again, because you're probably saving way more than what your mortgage was before you got the mortgage. So people that were good at saving and good at getting cash together before buying a decent level of a property, size of a property, usually find themselves cash rich in the next 2 to 3 years after the renovation projects. So which is interesting. I mean, it's great, I think, because people, when they're buying the mortgage for the first time after getting the house, they kind of think they're never going to have the money again, because it's so stressful leading up to it, and they don't know what they're paying for, and they're outbidding, and it gets a bit chaotic. But life just returns to normal. Once you build a house, move into the house, you do all the renovation work, you're back to normal. So, I mean, yeah, that's a good thing. I think it's great to get rid of the mortgage. A lot of people, when we talk to them as well from a financial planning point of view, the key things people want to do is to be mortgage free. And obviously, to retire early in any fashion, you'd want to probably not have a mortgage. So those extra payments are great. Let's talk about the reapprovals, and just explain to people what a reapproval is and what you're seeing there, please, Brian.
And just one other quick comment on the overpayments. It strikes me, yes, you move into the house, you struggle for the first couple of years, as you say, and maybe you have children. And actually you're thinking ahead, maybe one of the parties isn't going to work for a period of time. So they're saying, actually, can I reduce the cost of that mortgage for a period? And by paying off some of the capital, when you have that cash, you know, we all know how expensive the kids are going to be as they become teenagers and so on. So there's probably different strategies for people there. Reapprovals, I suppose there would have been a time, a few years back where, your typical mortgage customer would know how much they need to borrow. They would have their eye on a particular property. They would come and get an approval for that amount. And it might be the exception rather than the norm, where they have to come back to the bank and say, I need more money. Nowadays, it's probably the rule that they have to come back and look for more money, because unfortunately, as we see in the property market, what appears to be the price they're going to pay, bidding wars start, and they end up paying more. And there's a lot of, I describe it as urgency in purchasers trying to make sure they get on the property ladder quickly, because they just see this cost going up. So the main thing for us is, we try to operate a very efficient process there for our customers. They have an approval. We're more than happy for them to come back and have a conversation. Sometimes it's very, very straightforward. It's a small enough amount. They don't need to give us anything extra. And sometimes they may need to give us updated documentation to support a larger amount. But yeah, it's a big trend, and I suppose probably 3/4 of customers now have that experience. It's quite high.
Yeah, we're seeing that here actually ourselves, because obviously we have to do the resubmissions to lenders as well when somebody gets outbid, or they have to come back, or they get the pay rise and they need to borrow more. But it's a real sign of how much of a nightmare it is probably the right word for consumers out there that are trying to get on the property ladder, first time buyers, because that amount of what we would call them as reworks or redoing applications and getting them back into lenders. Obviously we do whatever we can to make sure our clients get on the property ladder and get the mortgage and hopefully live happily ever after. But the reworks and people having approval for over a year and then having to go back and borrow more. That's where, firsthand we're at the cold face of the market, and you're looking at clients and you're kind of going, this is getting absolutely outrageous. It's getting exceptionally worse on an annual basis. Let's go on to the Flex product. So we love the Flex product here at Ask Paul. I think it's a phenomenal product. So for we might give listeners a kind of run through what the Flex product is. And I mean, they're literally the lowest rates in Ireland. So you're looking at 2.98%. And you're looking at saying that range from 2.98 to maybe 3.1 for the next 12 months, you reckon. So they are exceptionally low rates. And there's loads of reasons why people should use these. Not just trying to get the lowest rate in the market, but it's all about flexibility as well, which is really what the Flex Mortgage stands for. So can you give people an update on how it's going, what you're seeing trend-wise again, and what people can expect from that product?
Yeah, Paul, the last time I was on your show probably was shortly after we launched it. I was delighted. I think you were the first radio show where we talked about this particular product. Very innovative. Part of the benefit of being part of the European Bank, we were able to take some of the European mortgage products essentially and deploy them in Ireland. Essentially for the listeners, what is Flex Mortgage? Flex Mortgage is a variable rate mortgage that is linked to the Euribor index. It's like a tracker, but it's not quite like a tracker. We set the rate on the day of your drawdown and you have that rate for the following 12 months. And every year after that, we reset that rate to whatever the rate is at the time and move it forward. And the great benefit of the product is that because it's linked to Euribor, it is linked to the actual cost of borrowing for banks. So what's been wonderful is we launched it at 3.31%. It is now 2.98%, as you say, the cheapest rate in Ireland. And the big benefit for consumers is that we've adjusted that rate every single month automatically as costs have fallen. And I can dare say no other bank has moved any variable rate downwards in that manner automatically as rates have fallen.
I think that's a big one. No other bank has done it. I'll get into my bank bashing part of the show. I nearly do it every week at this stage. But from the deposits we mentioned of 160 billion sitting over like current accounts and people not getting good enough returns on deposits when the European Central Bank's giving bigger, you see other banks across the EU, especially if you look at the likes of raising.ie and the deposit rates compared to Irish banks, it's ridiculous. But then again, you come to the variable rate mortgages, and even though it's been moved, banks are picking which rate to move. You see this with the green rates all the time, and it's just a marketing ploy. I mean, that's all it is, in fairness. So you see some banks taking one or two products only and moving them, leaving the variable rate where it is. But that's not good enough. It's just ridiculous. I think, and go back to this again, one of the biggest videos I ever did when we started the Ask Paul was, I was in Madrid doing a video outside Santander Bank actually, and I was talking about how low interest rates were for first time buyers. I think they were 1.5 fixed for 25 years at the time versus over 3% here in Ireland, nearly 4%. So, having the ability to bring that lending in. The other question I used to get all the time, Brian, was, Paul, can I borrow from a mortgage from a European bank because their rates are better and the products are better? And like, no, you can't. We don't do that yet. Okay, but deposits are getting there. But then you guys came in with all these amazing products, and there's a few more lenders in the marketplace. But these products are literally what you get in mainland Europe, and they run right across the Eurozone, and they're there typically to protect the consumer, to protect the system as well, because long-term fixed rates, people know what they're paying. These type of trackers as well that track the Euribor and all that. It's all really consumer-led, which we just do not get. I don't care what anybody says. I can have this out with anybody. You just don't get from the Irish banks. So I think it's amazing. I think it's great to see them in Ireland. And especially when you look at the possibility of rates falling more. Not sure they will. A lot of speculation about rates moving. I think where inflation is, it mightn't move as much as we think. But yeah, it's great to have that flexibility. And you've seen it then, the overall market growth. Like, what do you see? Because like, obviously, you've got the Flex Mortgage, you've got the one mortgage, we've got the overpayment. It's typically easier to do business as well from an application process point of view. So what are you seeing in the overall market then? Or what's we think the market is about 10%. What do you think is driving the growth? Is it just house prices, or is it people panicking? Like, what do you think on that growth piece?
So the industry just published its figures this morning, and we see the mortgage market this year up 10%. And with house prices up about 7.5% this year, some of that is accounted by house prices, some of that is pure growth. So what's driving that growth? So there's more first-time buyers. So 62% or so of the market is first-time buyers. That's up about 2% year on year. So more people are coming into the market, generally, with deposits, with gifts and so on, to afford the prices. But the big change in the market this year is the rise of switchers. So we're seeing switching levels up about 45% by value, right? So, Why is that? Well, what's happening is if you look back the typical 3 or 4 years of a fixed rate, you realise that rates back then were 2-point-something%. They're getting their 60-day letter, it's called, from the banks to tell them in 60 days' time you're going to be going to the rates available from their banks at that point in time. And those letters are typically telling them today that the rate is going to be 3.6, 3.8, something like that, right? And that is provoking them to say, hold on, my repayment is going to go up €200, whatever it might be, next month. What do I need to do? So a lot of those customers will go to their broker. And the broker is best positioned to look at the market, look at what's available, look at the different lenders. And it doesn't matter who you're with now, it's what's best for you in the future. And they'll go to us in a lot of cases because we've got the best rates.
It's very true. In fairness, that those letters are horrendous for people, especially the guys that we got on really good low interest rates back in the day. Things have moved. They took their lower interest rate. I think I was screaming at people about your 1.9 rate, I think it was, or 2.1 as well, to switch and get into these long-term fixed rates, which luckily a lot of clients did do. But yeah, for those that had a shorter time frame or think we're moving the next few years and when we fixed in, they're getting horror stories on the post, in fairness. Yeah, their rates are increasing and the monthly costs increasing. So I also think that people think because the interest rates are kind of bottom out with the European Central Bank, I think with inflation and those higher interest rates, I think as people feel the rates are coming down, I think over the last 12 months people are fearing, I'll stay where I am on the variable rate and wait for fixed rates to drop more and then I'll go in. But that's probably where your flex product comes in then, because you can switch to the flex product, stay there for up to 12 months, but at any stage decide to flip into the fixed rates. If you get nervous about interest rates or you see inflation numbers rising and you think its rates are going to go back up, you can jump straight from your flex variable right the way into your fixed contract. And there's no cost, no penalties, no anything to do that. So I think for a marketing piece, you kind of have the market covered more so from a switcher point of view. Sorry, for the first time buyers, everything, but in that switcher point of view compared to your competitors, having that flex mortgage and the long-term fixed rates is something I presume you're really proud of and obviously great to promote.
Yeah, Paul, it's a fantastic thing we have in terms of the range we have. We're the only lender that can give you both the kind of very short-term variable rate, and as you say, our rate is 2.98%. The next cheapest in the market is 3.75%, which is a massive difference, right? And we have the option of if you want a 3, 4, 5, 7, 10-year fix, whatever you want, or you want to fix for the full term, you have it. Now, the little trick I give my own friends and my own customers that I talk to are, take a flex mortgage now at 2.98. Watch what happens with interest rates over the next 12 months. You're locked into 2.98 if you take it with us today, right? At any point, the world goes bananas, rates rise, you've 2.98. And at that point, when you see that happening, switch immediately to a fixed rate. So if you get nervous, something happens, you will have time, you will be able to change. It usually takes a little bit of time for the central bank and so on to catch up on that. On the overall question of where rates are going and what they're doing, our best prediction is they're going to be stable for the next 12 months. That's the model we will be working to. Hopefully the world is stable, but we certainly see interest rates. We neither see them go up or down very much. They'll hover around the current levels.
Very good. Brian, it's always a pleasure to have you in studio. Thanks a million for all the information. For those that just joined us maybe a little bit late, you want to listen back to this, you can head over to Spotify, search for Ask Paul and Dublin City FM, and be able to get the full Today's Show, all the other shows as well, and that interview with Brian. And obviously, if you are strongly considering switching or the first time buyer, head over to askpaul.ie and check yourself out for a mortgage consultation where you can bring it through all the great rates and everything that Brian spoke about today, and making sure you're picking the right product that suits you and your overall financial situation. Because one thing I tell you have to do in 20,000 financial planning consultations here at askpaul is every single person's different when it comes to financial planning and what their needs are. So do get the mortgage consultation, have a look at all your options, especially if you're getting those letters that Brian spoke about, those 60-day letters for switchers. Or if you're a first-time buyer, likelihood you're going to be a first-time buyer for a period of time, maybe 6 months, could be up to 18 months or even 24 months. So having the flexibility to change those loan offers and improving principles right the way through is really important. So over to askpaul.ie for a mortgage consultation. Brian, thanks again for coming to the studio. Much appreciated.
Thanks, Paul. Have a great day. Thank you all.